Welcome to the Federal Retirement Podcast. My name is David Raetz from Benchmark Financial Group, and every month we discuss important topics regarding the retirement planning process for federal employees. This Lunch and Learn series is an interactive discussion where individuals can ask questions. To join these discussions live, you may register by joining our email list at bfgkc.com. Additionally, if you're looking for assistance to get your retirement on the right track, set up an appointment with us today. You can schedule an appointment online by visiting our website at bfgkc.com or email me at david.raetz@bfgkc.com. The contact information is also listed in the description. By setting up a complimentary consultation, we can review your financial situation and develop a plan to meet your financial goals. We hope you enjoy this topic and hope to connect with you soon.
Thanks for joining us on the call, everyone. Topic for the call this month is before you retire, 3 important decisions that can impact your income for life. So usually numero uno on the top of the list is zeroing in on a retirement date. Variables that you want to be aware of when you're thinking about what date would be the best to retire. So oftentimes with first employees, end of the month retirement is a popular one. Pension. Assuming you have end of the month retirement, pension payments start the first day of the month after you separate service. The annuity calculations start the next day. So it's a seamless transition. It definitely minimizes the gap between your final paycheck and then OPM processing your full pension annuity. Most of the time people will target end of the month for retirement. Well, one thing you don't want to do, if you can avoid it, like 5th of the month or the 7th of the month, because then you're going to have dead time until you get to the end of the month. HR and OPM are going to start crunching the numbers on your pension until you get to the end of the month. So end of the pay period retirement, generally the other options. And usually when this happens, if the pay period is like the 25th of the month and the end of the month is like the 30th, it's not usually anything to be concerned about because the gap there isn't a large chunk of time. But end of the pay period retirement ensures full service credit for pension calc. Sometimes people want to get higher salary on that last pay period for a high 3 calculation. Final paycheck's not prorated if it's end of the month. One of the bigger things at the top of the list is it maximizes your leave accrual. So that's a variable to be aware of when you're thinking about when is the best time of the year to retire. So in theory, you can carry over, most employees can carry over 240 hours of annual leave from one year to the next. So if you carry over the maximum and then you strategically save as many hours of annual leave as possible in your last year of employment, which would be 208 hours, in theory, you could sell back 448 hours of annual leave at the end of December, which is one of the reasons why a lot of people target the end of December for retirement date. And then he combines with end of the month retirement for best efficiency and seamless transition, so you don't have any extended delays or gaps. So why is the end of the year one of the more popular retirement dates for a lot of folks? December 31st is right up there at the top of the list, and usually it's to maximize your annual leave payout. For whatever reason, the leave year tends to end the first week in January. So going back to that idea of if you carry over the maximum amount of annual leave, 240 hours, and then strategically save as many hours as you can the last year of employment, and in theory, sell back 448 hours, that's usually a pretty decent chunk of change. And that leave payment gets paid by your agency. So a lot of times people will use that as kind of like a bridge payment to get from separating service till OPM starts spitting out your full unreduced pension payments. But one of the caveats about the leave check is that it's pretty much standard default that Uncle Sam is going to take 80% off the top for federal taxes. They don't take any state taxes, but you just kind of bank on your actual net deposit into checking is going to be 80% of whatever the gross leave amount is because of that federal tax withholding, which you can't do much about. Moving on a little bit more about end of the year retirement. Working through December, like you said, maximizes that leave. But another caveat about retiring at the end of December is that leave year usually ends the first week in January. You retire at 12/31. There's no delay in pension getting processed, but most of the time that puts people in a spot where that leave payment gets paid to them as income in the following tax year, because it's not actually going to get paid to you until January, which is a new tax year. So that's an important variable, especially because you wouldn't want to get like 4/5 of the way down through the year, or like set your retirement date and have things processed in like mid-November, and then you're getting that leave payment paid to you like right mid-December, late December, when the difference of a few days would have caused it to be taxable income in the following tax year, as opposed to, because usually those leave payments are anywhere between 15 to 20 to 25,000 bucks. So it's something to be aware of. If you have a pretty large leave balance that you're carrying from one year to the next, that's an important variable. If your leave balance isn't that big, then you got a lot more flexibility in terms of when you would want to retire. Sometimes people are targeting pay raises, so that sometimes that'll tie into the getting that pay bump calculated into their high three will impact their retirement too. So what happens behind the scenes? So your final paycheck and annual leave payment get paid by your HR. And then after that, they shift everything to the Office of Personnel Management. And OPM, usually you're on interim pay for about 2 or 3 months. And they're essentially auditing your service history, where they're verifying your service records, calculating your high three, coming up with a final pension payment amount, verifying survivor benefit amounts, payments that you might have to a former spouse. That's usually the one that delays things with OPM the longest. So that's something to be aware of. If it's something that's in your overall scenario, it's nothing to be scared of. It's more just making sure you do enough due diligence on the front end so that you don't have an extended delay with OPM processing your pension payments on the back end. We had a client that got married 90 days before her retirement date so that her new spouse could continue forward with health insurance. And she had all of her ducks in a row, but it's just a unique scenario that caused her retirement to get delayed by an extended period of time, like months, stretching almost to like a year plus. And that was an extreme scenario. But you always kind of throw your name in the hat, hope it lands on top with OPM, and hurry up and wait until they get back to corresponding with you. So it can be a frustrating spot to be in. But the more due diligence you do on the front end in terms of dotting the I's and crossing the T's in the right spot, the less margin for error there is, and extended delays and you getting payments from OPM and HR. So what you need to know or understand behind the scenes? OPM processing time generally takes about 2-3 months. And so circling back to that previous thought, the more colorful your service history is, generally the longer it takes to get your full pension check. So if you got a portion of the pension that's going to former spouse, that's something to package into the overall equation, because it's probably going to take a little bit longer than it normally would. But, and yeah, like I said, the more complex your service history, the longer it takes. And you definitely want to plan for that income gap, because under normal scenarios, it's usually about 2 or 3 months where you're on interim pay. So making sure that there isn't a gap in any of the money that's incoming to you, so you don't have any unexpected delays. And then interim payments are usually 60%, 70% of the final pension amount. You're going to get paid the money that OPM owes you, but they're also going to subtract out the health insurance premiums that you were supposed to be paying while they were crunching the numbers too. So it kind of evens out at the end of the day. But net effect is you're not going to lose any of the money they owe. It's just some of the benefits they're not paying. So moving on to step two, which step two would be bridging the income gap, planning for that period of time so that you don't have any unexpected delays in income. So oftentimes, like we said earlier, people use annual leave as a chunk of change to bridge the income gap between separating service and getting your final paycheck. So leave payment usually gets deposited within the first couple weeks of separating service. Like we said earlier, remember, Uncle Sam automatically withholds 20% off the top for federal taxes. Most retiring employees will be on that interim pension payment for about 2 or 3 months. Sometimes it's a little bit longer, and that's usually because of specific reasons. So if you got breaks in service, chunks of military time, former spouses, you want to plan for that on the front end. And then those interim pension checks, usually, like we said, about 60 to 80% of your first pension amount. It's just kind of frustrating. Like with OPM, you throw your name in the hat, hope it lands on top, and you don't know if it's going to be like 50% or 70% or 30%. But usually people want to be in a spot where they got enough liquid short-term money so that it's not a concern. And it kind of depends on where your retirement time frame is relative to age. Planning around 59 and a half is an important one. So sometimes people will set aside, whether or not it's just like accumulated savings, or depending on the timing of when they retire, if they're retiring from the federal government before 59 and a half, then you have to wait until you're retired to use ESP money. But if you're past the age of 59 and a half, sometimes people will roll money out of TSP prior to retirement so they have a chunk of money to work with for current income so that there aren't any unexpected surprises and money rolling in. So having enough cash reserves on the short term, remembering that leave payout is an important piece of the pie and fills that gap between separating service and getting that full pension payment. So creating your retirement paycheck is an important one. So deciding which income sources that you want to use, which generally pension's pretty mechanized. The first supplement, Social Security, is pretty mechanized, where people have a lot of flexibility is what they want to do with TSP. And sometimes people are in a spot where they need a maximum amount of income spinning off of TSP right at the point of retirement. Other times they want to have funds available for emergency opportunity type of withdrawals, which are usually house, car, medical, vacation type of withdrawals. So it's not a one size fits all scenario. And other times, so let's say you're in an early retirement scenario and you have the years of service in to retire at 50. That's a longer duration of time to plan for getting past 59 and a half than if you're retiring at like 57. So those are important variables to keep in the back of your mind. So like we said, pension, Social Security, fairly mechanized. TSP, you have a lot of flexibility. So circling back to the pension piece, some important decisions that you want to make that are gonna impact your net take home, or what do you want to do for survivor benefit? Because generally you have the maximum, which is 50%, or the partial, which is 25%, or no survivor benefit, which would put the most money back in your pocket. Usually in this scenario, if you've got one spouse that's the primary breadwinner, they usually default to the maximum survivor benefit 50. Sometimes you run into scenarios where both spouses have pension income. If that's the case, then usually or sometimes people will leave the partial, which is oftentimes enough to leave enough to cover the FEHB health insurance premium. So it's, again, this one's a little different for everybody. And then sometimes you run into scenarios where you have two federal employees and they both have pensions based off their own service history, and they both have access to subsidized health insurance. So it makes sense for them to go with life only options or put the most money back in their pocket while they're alive and well and enjoying retirement together. So like I said, every scenario is a little bit different for everybody, but it's important to remember that FEHB and the survivor benefit on your pension are directly intertwined with each other. So going back to that scenario, it's kind of like maximum, which is the 50% option, or the partial is usually enough to cover the cost of the FEHB premium for the surviving spouse. But again, it's not a one size fits all. So everybody generally has the same benefits, but the application is different based off of everybody's unique individual life scenario. This one's a snapshot because it's important to remember that you've got a lot of deductions that you pay for while you're working full time that go away at the point of retirement. So we always run a net monthly income comparison for folks, which just compares net monthly income while you're actively employed now relative to net monthly income at the point of retirement, because it helps to see that impact of the deductions that go away. Because it's easy to forget that you pay for a lot of stuff while you're working full time that goes away at the point of retirement. So in this scenario, we're looking at gross retirement income, deductions, and the net. So 6,200 was the gross retirement income, 3,700 were the deductions, net was 2,400 relative to, in the gross income, well, this person was actively employed, 8,800, current deductions, 6,300. So that had them netting out at 2,400 and change. But the thing to notice is that the gross income while actively employed is 8,800, but the gross income for as a retiree is noticeably lower at 6,200. But the retirement deductions are noticeably lower than deductions while this person was actively employed. So even though the gross retirement income was lower, the net was still put them in a spot where they're taking a small pay increase, because you don't have to worry about paying no more Medicare tax, Social Security tax, no more TSP contributions, no more first retirement contributions. So like we said a second ago, gross income in this scenario, 8,800, current deductions, 6,300, which netted them out at 2,424 relative to the retirement deductions, which were you're $37.99 and have that net be pretty much the same as they were bringing while they're working full time. So that's one of the variables that you always have to take into consideration when you're looking at that retirement income picture. Federal taxes are always going to be on the list. State taxes, depending on which state you live in, are still going to be a piece of the pie, but no more local tax in this scenario. FEGLI deduction went down noticeably. No more Medicare tax, no more Social Security tax. Federal employee health benefits going to be a piece of the pie, but no more TSP contributions, no more first retirement contributions. Savings allotments, sometimes that's a question of whether or not the savings allotments just go into savings account or whether or not it's going to an account that's paying like mortgage, which would still be a deduction at the point of retirement, and then dental and vision would still be on the list. So pretty much taxes, FEHB, dental and vision are the deductions that stay once you hit the point of being a retiree. So moving on to TSP distribution strategy, a lot of times people will employ a bucket strategy where you have a short-term bucket, a medium-term bucket, and then a long-term bucket. Or short-term, which would be income in 3 to 5 year window of time or income that you need readily accessible. Medium bucket would be liquid growth account, which you've got easy access to for fill in the blank. But usually that one, the medium bucket or the liquid growth account is house, car, medical, vacation type of withdrawals. Sometimes people like to divide out that account to a specifically separate chunk of money. So if you have all your eggs in one basket and you're taking monthly income and then you take an extra chunk for fill in the blank, you got to account for that. So you aren't taking out more on the front end than you'd otherwise need to and put yourself in a spot where you run out of cash too early. So generally, I guess in a general sense, oftentimes it's a short-term, medium, and long-term time horizon for certain chunks of money. And knowing your distribution options as well. So generally, that's when you're talking about lump sum or partial payment directly to you, that'd be like money that you're putting in your checking account. Full or partial rollover to a traditional or Roth IRA, fixed monthly payments, and life expectancy would be the fourth option. Generally, most people, it depends on where they're at, when they can retire, or the age that they can retire relative to how close they are to 59 and a half. So if somebody's retiring at like 56 or 57, sometimes they'll leave a chunk of money in TSP for a specific window of time, a specific amount that they want to have paid out to get them past 59. That's always something to keep in the back of your mind as well. Or things to consider. Having an adequate amount of emergency opportunity cash, that's always important. You definitely don't want to make emotional decisions. Rebalance investment funds periodically, and then evaluate the other retirement income sources too. You want to make these decisions in conjunction with money that you have coming in from pension and money that you have coming in from first supplement and Social Security. So this would be a snapshot of just a general TSP distribution strategy, or short-term bucket, medium-term bucket, and a long-term bucket. So in this scenario, the medium bucket, like we said earlier, it's earmarked for house, car, medical, vacation type of withdrawals. And we usually like to subdivide those out. So if you got the monthly income rolling in, you don't need to worry about how that withdrawal, or you don't need to worry quite so much about how that withdrawal is going to impact the monthly income that you have getting paid to you currently. So that's one to be aware of. And then a long-term bucket strategy as well, or money that's generally 7 to 10 years, what you're looking at there. This is an important detail to keep in the back of your mind too, is if you check that retiring at age 55 plus and you got 30 years of service under your belt, you can take distributions directly from TSP and not have to worry about paying the early withdrawal penalty. So sometimes, like I said, depending on how long of a duration it is, if you can retire at 50, that's a lot longer time horizon to plan for than if you're retiring at 57 and you got to plan around this 59 and a half age, but that's only 2.5 year window of time. That's different than like a 10-year window of time. And then if you're in the special category of like law enforcement, air traffic controllers, those type of folks, you can, if you check certain boxes, you can tap into TSP money at age 50, because those folks have mandatory retirement. So they have a unique caveat where they can tap into TSP money for monthly income a little bit earlier than most folks. Sometimes we run into scenarios. The earliest we had some clients that took year retirement that were able to retire at like 53 or 54, for instance. So sometimes people are in a spot where they can retire on an unreduced pension from the federal government. That's earlier than 55, for instance. So in those scenarios, there's another way to get access to TSP money without getting dinged with the 10% early withdrawal penalty, which is just an IRS code section of calculating the payment called a 72T distribution. And in a nutshell, as long as you crunch the numbers correctly, it's a way to distribute money from that pool of cash and not have to worry about paying the early withdrawal penalty. So this is just kind of a visual of how it works. Generally, you pinpoint what you want for the 72T distribution, and the rest of the money grows and compounds. Moving on to just a little refresher about FERS supplement. If you check that box of minimum retirement age with 30 years of service or retiring at age 60 with 20, you got the years in to retire with an unreduced FERS pension, but you're not eligible for Social Security yet. So if you're in that scenario, you get that Social Security bridge payment. And the more FERS years of service that you have under your belt, the closer that payment is going to be to your age 62 Social Security. So it kind of is not uncommon for the FERS retirement supplement to be about $500 to $1,000 a month less than whatever your age 62 Social Security payment is going to be. Social Security takes into account all of your working history and indexes those jobs for inflation. The FERS supplement just takes into account your FERS service. If you have military time that you bought back, that doesn't count in the FERS supplemental calculation. So, but either way, it's still a pretty nice chunk of change that bridges that gap from retirement to age 62. Paid by OPM to age, it automatically stops at age 62. It is subject to an earnings test, which it mirrors the Social Security earnings test. So for 2026, $24,480 is what you can make in terms of like W-2 salary income and not have to worry about that supplemental payment getting reduced or an extra $2,000 and change a month. And if you're in that special category, you don't have to worry about that earnings test until your minimum retirement age. So this would be like scenario where somebody who's an air traffic controller or law enforcement officer could retire at age 50 with 20 years, for instance. If they're in that scenario, they wouldn't have to worry about an earnings test until they got to 56 or 57. So sometimes people will retire from the federal government and then go work as a contractor. And depending on what you're planning to make working as a contractor, that's something to be aware of so you don't go over that earnings test amount. There are ways around it. It just depends on how creative you want to get with your tax planning. So just a reminder, non-work income doesn't count against the earnings test. So that'd be like government pension benefits, your first pension, investment earnings, interest, other pensions like state pension, annuity income, capital gains. Those don't count as earned income. And then if you're self-employed and you're getting paid as a 1099 employee, there you can set things so that the income counts when you receive it, not necessarily when you earn it or when you have it paid to you. So moving on to social, usually one of the last questions on the list is when should I start Social Security? Do I start it at 62? Do I wait till full retirement age? Or do I wait until 70 to get the maximum payout? Generally, we tend to gravitate towards turning Social Security on sooner as opposed to later. But that earnings test is an important caveat here. If you turn Social Security on any time between 62 and your full retirement age, you're subject to the earnings test. Once you get past your full retirement age, you don't need to worry about the earnings test anymore. So if you're getting Social Security, like in this scenario, full retirement age is 67. So if you're in that boat and you usually deferring Social Security to age 67 would be a situation where somebody wanted to retire from the federal government, but then could go work 2 or 3 days a week as a contractor, making essentially the same amount of money that they were making when they were working full time. But most of the time, we tend to gravitate towards turning it on sooner as opposed to later. Because really, how you win with Social Security is by turning it on sooner and squeezing as much money out of the plan and as possible, and living a long and happy and healthy retirement. You don't want to, or God forbid, you don't want to run the risk of waiting until 70 to get the higher payment amount, and then you pass away at 71. You paid in all those years, and Uncle Sam wins. And the reason the payment amount is higher at age 70 is because you're getting a shorter duration of payments out of the pool of cash that Uncle Sam's already set aside for your benefit. So, but if you've been getting that supplemental payment from retirement up until 62, most of the time people bank on turning Social Security on at 62. It usually depends on whether or not you want to work and earn income in your life after the federal government. bringing it all together, choosing the retirement date, bridging the income gap, and then creating your retirement paycheck or deciding how much TSP money it makes sense to have paid out to you, maximum amount of income, or having it invested and growing and easy access for fill in the blank. So how do you start a strategy? First meeting with us is always what we call a fact-finding meeting, where we send you a list of identifying information to gather. And the more accurate that info is, the more accurate we can be with the numbers that we crunch and present for you. Second meeting, we put together everything into a written plan called version 1. Sometimes it morphs into version 2 or 3 or 4, depending on what people want to do. But that'll break down choices for what you might want to do with pension decisions, family decisions, give you an idea of what income's going to be spinning off of first supplement. We'll give you a distribution or an income strategy of what to do with TSP money. And that's where we run the net monthly income comparison too, to give you an idea of any glaring gaps in net monthly that you'd be looking at. And then in subsequent meetings, it's an exercise in refining the decisions that make the most sense for your scenario, and then implementing the strategy and opening up accounts, getting things reinvested, and then adjusting on an ongoing basis from there, because life has a tendency to change. So it's usually a scenario people set a plan in place and then life happens, and sometimes it needs to be adjusted going forward. So the relationship doesn't stop at the point of retirement for the folks that we're working with. So what items do you need for the first meeting? Copy recent leaving earnings statement is number one at the top of the list. Any retirement estimate that you can get your hands on. Just a recent TSP statement so you can get an idea of balance, funds that you're invested in, what chunks you have in the traditional side, or what the balance is of the Roth on the Roth side, as an example. Any other investment accounts that you had earmarked for retirement income that you want to package into the conversation. Detail on any outside life insurance or insurance policies, long-term care, term policies, old insurance policies. Just a recent Social Security statement. If you've had a divorce, that's an important one to double check. Just rereading the divorce decree and how it would apply to federal benefits. And then sometimes people want to incorporate their spouse's benefits into the mix too. So thanks for tuning in, everyone. And if you think of a question that we didn't address on the call, feel free to give me a call directly, send an email, or you can always submit it via our website. Thanks for tuning in. Hope to see you guys in the near future.